Hi everyone, this is Sijia from Propedia. One of the very first steps you should go through before buying a property is your financial calculation and loan application. We often see clients getting confused by these financial terms and regulations, so today we'll be going through two financial terms which you have probably already heard of. MSR, which is the mortgage servicing ratio, and TDSR, which is total debt servicing ratio, and how they will affect your property purchase. MSR and TDSR are financing limits introduced by MAS which restricts the maximum financing buyers can attain to ensure they do not over-leverage on their purchase. There are a few differences between the two. MSR affects your loan size only for the purchase of HDBs, new ECs or ECs that have not reached their MOP, while TDSR oversees your overall obligations. To get a better understanding, let us go through how they are computed. Referring to the table, you can see that MSR restrictions are 30% of your gross monthly income. The loan assessment criteria using MSR takes in the borrower's existing property loan and adding in a new installment amount where the total of one's monthly property installment loans over the gross monthly income is less than or equals to 30%. TDSR refers to the amount of debt you have as a percentage of your gross monthly income. It governs your overall total monthly debt commitment as a maximum cap which takes into computation all your existing loans from property loans regardless of HDB or private properties, auto loans, study loans and even your monthly credit card commitments, and also adding in the loan you are currently applying for. The current guideline for TDSR is 55% where all monthly combined installments over your gross monthly income is less than or equals to 55%. There are certain ways to lower your TDSR percentage in order to attain more financing. First is to redeem your current outstanding loan, for example by paying off your study or auto loans earlier. Next will be to stop using your credit cards or ensure full repayment on them months prior to the application. Lastly, it will be through the showing of funds as a proof of wealth or pledging funds to the banks in the form of fixed deposits, which we will not be going through today. There are some other facts to note as well. Financial institutions tend to use a higher percentage of 3.5% interest rate when computing borrowers' MSR and TDSR as a form of stress test. This is why their loan amount tends to be slightly lower than what you estimated for yourself. It ensures that buyers will not face financial difficulties even if interest rates do shoot up. There are two groups of borrowers who will face more restrictions on their mortgage application. Those with variable income such as commission earners, like interior designers, insurance and property agents, or even fixed salaried workers who have a large amount of variable income. The other group will be self-employed individuals such as freelancers and business owners. Financial institutions only recognize 60 to 70% of their income as a conservative measure due to the fact that their income can fluctuate tremendously. While these regulations do hinder some buyers on getting their perfect unit, we were introduced with good intentions in mind. They ensure borrowers do not overcommit to a property they cannot afford as a home purchase and mortgage is a long-term commitment. It also assists in keeping prices lower for everyone by ensuring property speculators think twice before purchasing. Thanks for joining us today and see you in our next video.